Welcome back. The auditor is able to give an opinion that provides a high level of positive assurance that the financial statements are true and fair, or fairly presented, because that opinion is based on evidence. In this video, we look at the nature of audit evidence and the procedures used to gather that evidence. Our key standard on audit evidence is ASA 500. Evidence is all the information used by the auditor to form the opinion. That obviously includes all the accounting records and supporting documents of the client entity, as well as corroborating information from other sources. So those other sources include things like evidence developed by the auditor themselves or obtained from third parties. The auditor doesn't have to get every single piece of evidence in existence. Evidence only has to be persuasive that an assertion is fairly stated. It doesn't have to be 100% certain or conclusive. As we already know, it only has to provide reasonable assurance, not absolute certainty. The standard says that the auditor has to gather evidence that is sufficient and appropriate. So let's look more closely at what those two terms mean. Sufficient evidence means the amount of evidence or the quantity. Appropriate evidence means it's got to be the right kind of evidence. In other words, that relates to the quality of the evidence. So sufficient and appropriate, quantity and quality of evidence. So looking at quantity first, how much evidence is enough? Well, this is a matter of the auditor's professional judgment. A basic principle is the more at risk of misstatement an assertion is, then the more evidence is needed to bring down that risk. Often sampling is used in auditing for reasons of efficiency and hopefully also effectiveness. Cost-benefit considerations are important. I can get more evidence and keep getting more evidence, but that will take longer and therefore cost more. So there's a trade-off. Is the reduction in the risk of misstatement greater than the increase in cost of the additional evidence? Appropriate, as we said, means that it's the right information. Now we know that the two primary qualities of information are relevance and reliability. So by relevance, for the auditor, we mean the evidence must be relevant to the assertion being tested. Reliability is obviously a factor of the quality of the evidence, and audit evidence can vary in reliability, depending on the nature and the source of the information. But again, the principle is the higher the risk of misstatement for an assertion, then the more reliable we want the evidence to be to verify that assertion. Let's identify some of the factors that influence reliability of evidence. First of all, the independence of the provider. Where's the information coming from? So if it's coming from management, then obviously they're not independent compared to a third party, such as, for example, a bank. If the information is coming from the client's accounting records, then its reliability will depend on how effective the client's internal controls are. Are they operating effectively? And this is something that we look at over weeks 6 to 8. The auditor's direct knowledge, of course, is seen as being a more reliable source of evidence. The qualifications of the individuals who are providing information to the auditor, so the better qualified the person, the more reliable the evidence. There's characteristics of the evidence itself, the degree of objectivity. So an important point here is this internal versus external evidence. So for example, a management prepared depreciation schedule or a management assessment of the impairment of asset values, these are quite subjective values, as opposed to, say, a bank statement, or we've got contracts or invoices or receipts with an external third party, which is much more objective. Finally, timeliness. Of course, the closer in time the bit of evidence is to our point of audit, whether it's the balance date, end of year balance, or the date a transaction is recorded, then the more reliable that evidence. So we're looking a little bit more closely here at the source of the evidence as an indicator of its reliability. So we have a hierarchy of reliability. So at the top of the slide, we have the most reliable evidence. At the bottom, we have the least reliable. So the most reliable forms of evidence are documents that have been externally generated, so that is by some third party external to the client entity, that have been sent directly to the auditor. For example, bank statements, bank confirmations, and confirmations that your client's debtors have returned directly to the auditor confirming the amount that they owe the audit client. Next most reliable are documents which were originally generated externally to the client but are held by the client. So suppliers' invoices and bank statements. Okay. The fact that they're held by the client means there's a possibility they may be altered in some way, so less reliable than having been sent straight to the auditor. Next are documents that are internally generated, but they have some external circulation. So a deposit slip that the bank has receipted, for example, that it's received the cash, or a shipping document which has been receipted or signed by the recipient that yes, they actually did receive those goods. Then, last of all, internally generated documents that have not been circulated externally. So things like duplicate sales invoices and purchase requisitions. So, of course, the most unreliable kind of evidence is not even on the slide, and that is oral evidence. You ask somebody something and they tell you an answer. You can't rely on that as an auditor. You must always get your own evidence to back up what somebody tells you. Okay? If there's no alternative forms of evidence, then you have to document what you're told, put it in a management representation letter, and get management to sign to take responsibility for that information. Okay? So remember, our key principle about evidence is the greater the risk of misstatement of an assertion, the more evidence we need and the more reliable we want that evidence to be. This slide lists the different types of audit evidence. Documentation being the client's accounting records, journals and ledgers, and supporting documents, both paper and, of course, electronic. The other types are what we call the corroborating evidence. Evidence that you get to corroborate, in other words, to agree with the information in the accounting records. Then we also have the procedures listed that are used to gather that evidence. So just running through a few examples there. Physical examination. So this is what we do, for example, with a client's inventory. We count it at stock take, we inspect it that it's still there for its existence. Confirmations, as we said, we send those out to third parties such as the client's debtors to confirm directly back to the auditor about the amount that they owe. Observation could be observing client personnel doing their jobs, whether they perform their controls, whether there's separation of duties and so on. Inquiring of the client can be a big variety of questions that could be asked there. Recalculation, so for example, recalculating a depreciation schedule, and reperformance could be redoing a bank reconciliation to see if the auditor comes up with the same answer as the client does. You can read more detail and more examples about these types of procedures and the types of evidence in Table 5.6 in Chapter 5 of your textbook. Now, highlighted on both are analytical procedures. These are a very important type of audit procedure that result in auditor-produced analytical evidence. So we'll focus on analytical procedures, or APs, in our last video. The other important procedure is tracing and vouching that we will now have a closer look at. Tracing and vouching are classic audit procedures for verifying accounting transactions and balances. They differ in the direction of testing because each direction tests a different assertion and has a different objective. So we need to do both. We need to both test in both directions. So let's say, for example, we have sales transactions. So for tracing, our source document is our sales invoices. So we take a sample of invoices, we trace those to where they're entered in the sales journal, we trace them from the sales journal to the accounts receivable balance. So this is testing for completeness. We're making sure that sales which happened all ended up recorded in the ledger. So if they were not recorded in the ledger, then the balance would be understated. So tracing is testing for understatement and verifying the assertion of completeness. For vouching, we test in the opposite direction. So we take a sample of debtors that are, say, in the accounts receivable control account, and we match them back to the sales journal, and then from the sales journal we find and match them to the original sales invoice. So what this is testing for is that original sale is a genuine sale that actually happened, and therefore the debt in the accounts receivable balance, the debtor, really exists. So if it didn't exist, then the accounts receivable balance would be overstated. So this is an example of our evidence needing to be relevant to the assertion being tested. So the right bit of evidence differs depending on whether we're tracing or vouching. In our final video, we'll look at analytical procedures as a particularly important type of audit procedure.